Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at CLS, or Celestica Inc. CLS is one of the largest electronics manufacturing services companies in the world, serving the computer and communications sectors. Here's the barchart.com technical opinion rating for CLS. The bar chart technical opinion rating is a 100% buy with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, the stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that CLS is well above the moving average line, so the monthly trend in CLS is up. Now we're going to look at the daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since January, so the daily trend in CLS is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. The CLS stock price is below the upper Keltner channel line, so CLS is inside the buy zone. Since the trend is up, we want to buy a call. CLS has plenty of option chains to choose from. We're going to use the July 19 option chain. Right now, the July 19 options have 19 days until expiration. Here's the CLS option chain for July 19. CLS closed at 57.33 on Friday. That means any calls on the list from 17.5 to 55 are in the money. Let's take a look at the profit potential for purchasing the 57.5 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 57.5 call is 245 to 265. We try to enter at the midpoint, so we'll use 255 as the buy price. Our call option calculator shows the profit potential for this call based on CLS price changes at option expiration from flat to a 12.5% increase in price. We can see that if the CLS stock price is flat at 57.33 at option expiration, the 57.5 call would lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 55 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 55 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the CLS stock price is up 1%, the 55 call will lose 25.6% of its value. We want that to be break even or better, so the 55 call does not meet our requirements. Let's see if the 50 call will work. The bid-ask spread for the 50 call is 610 to 8 even. We're going to use 740 as the buy price. The call option calculator, or the 50 call works. If the CLS stock price is up 1%, the 50 call will make a 6.8% or $50 profit. That's better than break even, so the 50 call is the one we'll buy. The call option purchase calculator also shows that if the CLS stock price increases by 2.5%, the 50 call will make an 18.4% or $136 profit. If the CLS stock price increases by 5%, the 50 call will make a 37.8% or $280 profit. If the CLS stock price increases by 7.5%, The 50 call will make a 57.2% or $423 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the CLS stock price does not make the expected move up and remains flat at expiration, the 50 call would only lose 0.9%, less than 1%, or minus $7, compared to the minus 100% or minus $255 loss for the 57.5 strike that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the CLS July 19 50 strike call and sell to open the CLS July 19 55 strike call. We want to buy the 50 call for $7.40 and sell the 55 call for $3.90. $7.40 minus $3.90 equals $3.50. So the entry price or debit cost for the spread is $350. The call option spread analysis calculator picture shows that the spread will make a 42.9% or $150 profit if the CLS stock price declines by 2.5%, remains flat, or increases in price when the options expire. If CLS is down 5% at expiration, the trade will make 27.5% or $96. If CLS is down 7.5% at expiration, the trade will lose 13.4% or $47. Creating the debit spread will allow us to collect a $390 cash credit to our brokerage account for the sale of the 55 call. As we said on the previous slide, this reduces the cost of entering the spread to $350. Here's a note regarding earnings reports. The next CLS earnings report is scheduled for July 17th, 2 days before these options expire. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the CLS July 19 expiration 50 strike call for $7.40. We also reviewed a spread. The spread said to buy to open the CLS July 19 expiration 50 strike call and sell to open the July 19 55 strike call at a debit of $350. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.